Good afternoon, ladies and gentlemen, and welcome to the AFERIAN PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so, and these will be available via your Investor Meet Company dashboard. Before we begin, I would like to submit the following poll. I would now like to hand you over to CEO Donald McGarver. Good afternoon, sir.
Good afternoon, Jake. Welcome, everybody, and thank you for attending our interims update. Today, we'd like to take you through, obviously, the interims for the first half of this year, highlights, a bit on the market outlook, and the financials for both 24i and Amino. Wrap it up, and then open up to any questions. As Jake said, please, if you have questions, please stick them in the Q&A section, and we'll do our very best to answer them today, and if not, we'll do that later on. So first of all, it's fair to say that video streaming is now part of everyday life. It's very much the dominant method of which video is now distributed, and is now overtaken both broadcast and cable in the North American marketplace, and we're seeing that elsewhere in the world. And it's easier than ever to watch any video that you want over the internet, over broadband, and whether that's the familiar services that we've all got, like Disney and Netflix and the BBC iPlayer here in the UK, to some that are maybe less well known, a little bit more niche customers that we have, such as Tastemade and Broadway HD. We're getting unique content delivered whenever, wherever we want to, and at any and every device that we can possibly have. And we're also seeing that the devices, or the content and the video and the entertainment and the information, becoming far more readily available in public settings and our everyday life, whether that's in airports, in betting shops and football stadiums, as we've delivered for our customers in the UK and Europe, or whether that's across retail, the high street, transportation, or any entertainment venue that we all go to. And we're seeing more and more content, more information, more video, and being delivered through what we call digital signage. And I'll come back to that because it's become an important part of our portfolio going forward as a company. And what we have is we have the two divisions inside the AFERIAN Group. We have 24i, which is our end-to-end video streaming, video content delivery solution and services, where we deliver any video and any content to any device, wherever the subscriber wants to watch that. And this is achieved through our applications, a productized front-end solution, and obviously our back-end actually manages all of that to make sure we get the right content in the right way, delivered to the right subscriber, the right device, whatever that may be. And then there's the Amino division, which really looks at supporting telcos and network operators deliver their TV services over broadband, and allowing them to display content not just on the devices that we're familiar with in our homes, but also in these digital signage products that we see becoming ubiquitous in our daily life. And we do this through a set of devices bundled and integrated with a suite of software, and also our remote management software, which we call Engage, an important part of our solution for reducing total cost of ownership for our customers, or for Amino's customers, in network operators and telcos. So moving on to how the interims and the results. Look, I'm very pleased to say that we've continued to execute extremely well on the software-led strategy. And as video streaming market continues to grow, we've continued to prosper through 24i, revenue up 18% year over year. And as you can see, very pleasing for us, our total ARR, annual recurring revenue, up almost 20% over the same period last year. So continuing to get good growth in that area, and seeing that continue to grow in double digits going forward as well. However, as well known now, we did see a significant decline in the device business, in the amino business, and with a 70% decline in revenues from that device business, that's had a material impact on our revenue, our profitability, or EBITDA, and also on our operating cash flow, having a fairly negative performance. I'll hand over to Mark, who'll talk us through a little bit more on the numbers.
Thank you, Donald. As Donald mentioned, we've seen a decrease in our revenues from 44 million last year to 23 million this year. In spite of the increase in software revenue, up 17% year on year, we have seen a significant decrease in device revenues, which has had a knock-on impact on our gross profit and our EBITDA. Our gross profit margin has increased, mainly due to the higher proportion of software and services revenues within our total revenue figure. However, our adjusted EBITDA figure is down nearly $6 million, mainly driven by that reduction in device revenues. Clearly, we've taken cost reduction actions in the period and post-period end, which I'll take you through in more detail later on in the slides. You can see from the exceptional items of 1.2 million in the half, which relates to restructuring costs of both the Amino and 24i cost base in the first half. That was $1.2 million. And with additional cost reduction actions taken in the second half of the year, we expect that number to be broadly double by the end of the year. Clearly, our amortization of intangibles has gone up with the acquisition of 24iQ, and our net interest has gone up in line with our debt levels. Move on to the next slide. This slide shows our cash flow bridge between November and May, so November FY22 to first half May 31st FY23. The biggest impact on our cash flow is the working capital outflow of $7 million, which relate to payments for inventory built up in H2 2022 as a result of the lengthening supply chain times that we saw back during COVID. The exceptional costs here relate to $4.1 million payments for professional fees for the previously aborted acquisition in 2022, plus also the restructuring costs that I mentioned earlier. Our capitalised development costs of 3.3 million are significantly down on the run rate of over $8 million last year, and they will reduce again in the second half of FY23 as a result of the cost reduction actions we've taken. The net debt number here includes the Kestrel loan, but clearly excludes the post-period end fundraise of $4 million. Moving on to 24i financial performance, we can see a good increase in both revenue and exit ARR, which has increased by 22% and 26% on a constant currency basis, respectively. That revenue growth has been driven both by new customers and existing customers, and you can see the net customer retention rate there of 109%, showing good growth from existing customers during the period. This has had a knock-on impact on the profitability of the business, with gross profit up to 8.1 million and adjusted EBITDA up to 1.4 million. In terms of the savings we achieved in the first half, we achieved annualized 1.6 million and annualized 0.7 million capex during the period. We have identified further cost reduction actions in 24, which are underway and expected to be completed very shortly.
There we go. Sorry, it took me a little while. As it says there, our focus very much is on the profitability in 24i division. We've invested in our product and the product portfolio, and we feel that that's at the stage where it's now being monetized and capitalized on as we go forward. We've continued to have a strong sales pipeline and some notable customer wins against that. We had announced, obviously, for the World Cup, the Israeli broadcaster Can, and we continue to develop the solution and the product with Can as we went forward. In March, we announced a partnership with Amagi. Amagi are one of the leading providers in what is called the new FAST technology, and that's free ad-supported TV, where television is monetized through the advertising and provided free of charge or at a reduced subscription rate to the end consumer. And just 2 weeks ago, or maybe a bit less than that, we announced the conclusion of our first foray into that market with Amagi, where Virgin Media here in the UK deployed 14 fast channels. And if you have Virgin Media, you can actually go in and experience those. So able to give free channels to their consumers to deploy and to watch as well. And we've seen through the data and the analytics, obviously, that there's been a significant take up in that, and is a very popular now part of the service that helps Virgin not only monetize that content and the content providers, but also retain and increase customers going forward. We have, at this point, over 90%, a little bit higher than that actually now, of our business now contracted for the remainder of the year. So, and again, a lot of that being recurring in nature. And we did put in place some cost reductions back in February to improve profitability. And we're doing another round of that right now, which will conclude shortly, that will continue to improve the profitability whilst at the same time growing the business quite successfully. If we look at the market, streaming continues to boom. It continues to be where most operators, broadcasters, content providers continue to invest in the technology because they want to get more content to the end subscriber. And actually, we've seen for quite some time now that streaming become the dominant way of viewing content. And if we look at the North America, the largest market globally by quite some way, we've now seen that over 36% of TV is viewed via streaming, whilst both cable and broadcast, seeing fairly significant declines as people switch their viewing habits over to streaming. And so therefore the strategy for 24i remains unchanged. It's about growing those software revenues by capitalizing on a market that continues to grow. And we do that through our suite of products, the three that we've named there: Mod Studio, which is the end-to-end modular platform that allows us to deliver to any device. We've got 24IQ, data analytics solution to help provide personalization and recommendation, either bundled as part of a solution or as a standalone that we can offer to clients separately. And then finally, in the pay TV space, we offer Focus on TV. That's offered in the cloud as a TV as a service platform to help operators gain traction with their customers. I'll hand back to Mark just a little bit on the Amino financial performance.
Yeah, so moving on to the Amino financial performance, you can see the impact of the revenue decline on the right-hand side on both revenue and gross profit. Gross profit margin has gone up as there is a level of software within the Amino business of $2 to $3 million per half. That clearly is high margin and has helped increase that gross profit percentage during the half to 50%. Strong repeat orders from existing customers over that period, as always, but the biggest impact clearly has been on adjusted EBITDA, which is negative during the period due to the reduction in revenue. In terms of the cost savings we've achieved, we've set out the cost savings here we achieved both in February and post-period end in June to right-size the business. And we achieved savings of annualized 4.2 million operating costs and $1.2 million capex. You see the inventory balance there going up from $4 million in H1 2022 to $8.6 million in H1 23. And clearly we are working on a plan to reduce that. Inventory levels are reducing as expected, but we don't expect those levels to reduce back to the November 2021 levels, which were around about $3 million until H1 2024.
And if we look at operationally, again, for our expectations for revenue, we are over 93% of revenue contracted. That's made up of committed backlog and orders that we need to deliver within this year. And also some of the software and services that's recurring in nature or contracted or ready to be delivered as part of the year. So good visibility around our revenues there. And we can expect that within 2024, levels growth will return, albeit from a lower base, but that happens naturally as we deplete this year, for example, into North America, running at run rates of $13 million and more. We'll be delivering only $3 million of inventory in there. So we'll naturally see that deplete, and the requirement to continue to fulfill the market in 2024 help us get back to good growth in the following year. We continue to see good progress in digital signage. We've talked about, we've some announcements of putting this into customers in Mumbai Airport and other areas coming up shortly. We have taken fairly significant action to address and right-size the business to align with our reduced revenue levels, but actually improve our profitability. And as Mark said, inventory has continued to come down and will continue to come down to more normalized levels as we go through this year and into 2024. And if we look at the outlook, the overall pay TV market is declining, but within that, as I said before, streaming continues to become the most dominant way of supporting that market. And even pay TV streaming devices, like our own, is continuing to see growth as operators, trying to get switched to streaming and trying to get cost efficiencies. The digital signage market is growing, at 8-9%, and we continue to see great opportunity there. So therefore, the strategy for Amino is to focus on those areas, not only where we can participate, but we can add most value. So we're focusing very much on the higher quality, higher margin pay TV devices, where we have good market share and there's a decent level of barriers to entry. And also focus on digital signage, where again we see growth and we have some very competitive devices that we can take advantage of in that marketplace. In addition to that, our SaaS device platform has continued to perform well, gain traction, add subscribers and operators to it. And we see that not only continue to grow, but also in some new areas where we'll sell that directly to operators, bundled along with third-party devices, as well as our existing Amino devices. So post-period end update, we did an equity placing, as I'm sure you're familiar with, of $4 million gross just a month ago. We continue to reduce the Amino inventory to try and reduce our debt, which we are getting through successfully, and we remain fully in compliance with all of our banking covenants. We continue to look at our costs and make sure that they are right-sized. We've taken $8.2 million already, with a little bit more to follow this month as we conclude the 24i cost savings. We've got good contracted revenue and backlog, and we expect to return a material positive adjusted EBITDA this year. We made some changes in the board. We added some capability through a new technical leader that came in as part of the board to help advise, guide, and provide some counseling to make sure that we've got the right strategy around our products, our technology, to go forward. And we've added a guy called Alan Broom. He's based out of the US. He's currently the chief executive at MediaKind, who is one of the other leaders in our space. So good to have him on board and to be able to support the team and the board going forward. So expectations for 2023, we expect to continue to grow our software and services, as we've intimated. Operating margins and profitability improving, particularly in our 24i division. So we are, capitalizing on those investments that we've made in our products and our portfolio and our solutions. And we've got a good deal of backlog already secure. So we expect the debt to reduce as we burn off inventory and improve our cash generation and profitability going forward. So all in all, expectations good, and continue to execute very well on our software strategy. So that concludes the presentation, and we'll now open up to any questions that you might have. I'll hand back to Jake.
Donald, Mark, that's great. And thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Mark, Donald, we did receive a number of pre-submitted questions ahead of today's event. And as you can see there in the Q&A tab, we've also received a number of questions throughout your presentation this afternoon. So firstly, thank you to all of those on the call for taking the time to submit their questions. And Mark, Donald, if I could just hand back to you just to make your way through those questions and give those responses where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Okay, well, I'm going to hand the first one over to Mark, which is, there's one here. What would be the annualized cost base, OPEX, CAPEX, after the cost reduction actions are completed?
Yeah, so there's a few questions on this. We've so far made $8 million worth of annualized cost savings. And the easiest way to compare that is to compare that against the FY22 numbers if you're looking at trying to do a forecast for FY24. We haven't yet published the numbers for the final 24i restructuring because that's not yet complete. So once we have that, we'll give that in our trading update in December.
We've got a question here. What is the split of ARR between Amino and 24i? So the ARR in 24i was 14.2 million, and the ARR in Amino was 4.6 million, which brings us to the total 18.8 million that we reported. Question there, Mark. What is driving the increase in adjusted OPEX at Amino?
So the adjusted OPEX fell last year from 6.2 last year to 5.5 this year, and that will fall again in this half. So I'm not quite sure where that question is coming from, but hopefully that's clear for everybody.
Next question. What did you pay for the 24i acquisition, and what have you invested in this division since?
So in terms of that question, so the 24i acquisition is multiple acquisitions. So it comprises the Books Media acquisition done in 2015, the 24i acquisition done in 2019, subsequently the Nordia acquisition, and also the 24iQ acquisition. And the carrying value of those combined and integrated acquisitions on the balance sheet is 44.4 million euros.
Slide 30 at your presentation here this time last year showed competitive landscape with both 24i and MediaKind in the back-end control section. How much overlap does this cause a problem with Allen Broom? And no, listen, we carefully consider that because we do, there is a crossover in terms of the space that we operate in, but MediaKind does operate in a different set of clients and opportunities. So we don't believe there's going to be any conflict. And if at any time we thought there was, we'd obviously in the board make sure that we had some respective walls that we can make sure that that doesn't become an issue. It's been a fair amount of time since the aborted acquisition last year. Are you able to share more details now about the target company, the reason why you aborted, and explain the breakdown drivers of the 5.5 million spent on professional services? Thanks. No, we're not in a position to identify where that was, other than to say, it would have been, it would have been very material acquisition, and it would have made a significant transformation of the business into software and services. It was aborted, obviously, because we saw a downturn in the marketplace, and we were very close to concluding that acquisition, but unfortunately that change resulted in us having to abort at the time. And the breakdown, I mean, a lot of those costs were driven because it would have been a reverse acquisition, and therefore we had a lot of costs of preparing for that, as well as traditional due diligence. Mark, do you want to say anything else about that?
No, I think that's right. I mean, clearly, we're doing a reverse acquisition. There's IFRS conversions, there's audits, there's due diligence, and there's all the compliance required to do. So a lot of that was regulatory driven rather than commercial due diligence.
Next question is, how is having a Kestrel rep in the board assisting the business? I think Kestrel have been a fantastic member of the board. We're really pleased to have them on board. We certainly do get feedback of how investors feel about the company and we're operating, and they have been extremely supportive. As you've seen, they put in place a loan, and we had a further opportunity to take advantage of that. But we chose to go down through a placing, which again, Kestrel participated in as well. And we're very pleased the support and guidance that we get from a representative on the board. So I think that's been very good for us, and it's great having somebody like that who is supportive and can help give us a bit of guidance as well. You make reference to your partnership with Amagi. What KPIs are you using to monitor the success of this partnership? Well, clearly it's about winning business together. It's the number one. And I'm pleased to say that we've taken the first steps there. We're obviously working together to extend the portfolio and the solutions. And, we've got a lot of operational KPIs. Again, we talked about Virgin Media launching that, but making sure not only that it launches, that it's getting good traction with consumers and subscribers, so that it's doing the right thing for our end customer. And that is, and it's been a very strong and successful partnership. And I believe the pipeline that we're generating together, it will give us more benefits as we go forward. Where do you expect Amino device revenues to return to once destocking and cost of living pressures ease? Are your expectations of recovery still similar to scenarios presented for the goodwill impairments in the 2022 annual report? Mark, do you want to answer that one?
Yeah, so in certain, I'm also reading down a bit further, Donald. There's another question about the collapse in device sales and the outlook for this sector. Would it not be better to close this division? I think the Amino division, and focus on 24i, which is growing. I think the two are probably interlinked in terms of the stability of the Amino division. When we look at the Amino division, it is currently profitable post the cost restructurings we've done, and we've right-sized the business for the level of revenue that we see in that business today. So clearly, as it is cash generative, and as we are running down the inventory, which will generate more cash to pay down our debt, it's not within our interests at all to close this division. We do see a long-term future for this division. We are investing in sales and marketing for both the software device management platform, as well as the digital signage business, as well as the traditional telco business. And that business is now stabilized. And what we see is that as that destocking impact abates, which we are seeing, is that we see that we have a very conservative forecast of that business being stable in its revenues. So clearly it does have a long-term future, which we believe in. It is also generating cash, and it has stabilized its revenues. So we do think it's a good division to hold on to, absolutely.
Next question. You mentioned that inventory should over time run back down to previous levels. Could you describe what that, alongside the hope for stabilisation of revenues, might mean in terms of working capital changes going forward? Right. In terms of working capital, I mean, as we've sort of indicated there, we do expect that to go back to more normalised levels. We have been carrying quite a bit of inventory as a result of the kind of post-COVID period. But again, none of that inventory is obsolete inventory. It's all good inventory that will be built into products and delivered to customers. And our focus operationally is in depleting that and getting back to normal, which was sub $3 million we used to carry, rather than the kind of 8.6 that we'd reported at the half year.
I think we've answered the remaining questions. The other question at the bottom there, what level of net debt would the company like to get to in FY24? I think we reported net debt levels at the half year of about 12 and a bit million dollars. Since then, as you know, we've raised 4 million gross, $3.5 million equity, and we have a plan to run down the inventory levels in amino, which means that we do have a runway of significantly reducing that net debt by the year end. And with the business now in cash generation, having done the restructuring costs, we can reduce that further in FY24.
Donald, Mark, if I may just jump back in there, and thank you very much indeed for addressing all of those questions that came in from investors this afternoon. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended, just for you to review, to then add any additional responses, of course, where it's appropriate to do so, and we'll publish all those responses out on the platform. But Donald, perhaps really before just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Yeah, I mean, clearly it has been a challenging period. We believe we're now well and truly through that. We've got a great software business growing in a growing market, and generating increases in not only in revenue but recurring revenue, which is a very strong sign for the business. And our amino business, now been sort of fully restructured, is back into profitability and cash generation, and we believe it has stabilized, and we'll move onwards and upwards from there. So, as I said, been challenging. We certainly feel we've now got that behind us, and there's an air of confidence around the business that we can continue motor on from here.
Donald, that's great. And Mark as well, thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This won't take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of AFERIAN plc, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.